Hello everyone, welcome to the 80th episode of me learning how to trade in Forex. So in the last video we went through trend retracement or reversal. We found out the reason for differentiating, actually no, let me rephrase that. We found out how to differentiate the two, so what is meant by a retracement and what is meant by reversal. So retracement is a temporary price movement against the established trend. So we can see that the overall trend is going upwards, but then there's many trends that are going downwards. Trend reversals is a change in the overall trend. So you can see the starting bit here is an uptrend, but then there's a reversal point here, and then the overall trend then turns into a downtrend. So that's trend retracement and trend reversals. And then we have three options when facing a possible retracement or reversal. So we can either hold on to our position, close our position, re-enter, or close our position permanently. And each of them comes with their own scenario, I guess. So yeah, and also trailing stop loss is a great risk management technique when trading with the trend. And now we are on to how to identify reversals and retracements. So, how to identify reversals and retracements. 20th. So, properly distinguishing between retracements and reversals can help reduce the number of losing trades and even set you up with some winning trades. Classifying a price movement as a retracement or reversal is very important. It's up there with paying taxes, cough. There are several key differences in distinguishing a temporary price change retracement from a long-term trend reversal. Here they are. So, several key differences in this distinguishing. So, how to spot a retracement compared to reversal. So, retracements, how to spot a retracement. So usually occurs after huge directional price movements. Short-term, short-lived reversal, short-term and short-lived reversal. Fundamentals, i.e. the macroeconomic environment, do not change. Fundamentals, so i.e. the macroeconomic environment do not change. In an uptrend, buying interest is present, making it likely for the price to rally. In a downtrend, selling interest is present, making it likely for the price to decline. In an uptrend, buying interest, making it likely for the price to rally. So in an uptrend, buying interest is present, making it likely for the price to rally. In a downtrend, selling interest is present. Making it likely for the price to decline. Okay, so reversals. How to spot a reversal. can occur at any time. Can occur at any time. Long-term price movement. Long-term price movement. Fundamentals do change, which is usually the catalyst for the long-term reversal. Fundamentals do change. Which is usually the catalyst for the long-term reversal. And then in an uptrend, there is very little buying interest. Forcing the price to fall lower. In a downtrend, there is very little selling interest, forcing the price to rise higher. Right. So retracement, the first point makes sense. Reversals happen any time. Usually occurs after huge directional price movement. Short-term retracement, long-term reversals. Fundamentals, i.e. the macroeconomic environment, do not change. Fundamentals do not change. Whereas this one, fundamentals do change. In an uptrend, buying interest present, making it likely for the price to rally. In an uptrend, there's very little buying interest, forcing the price to fall lower. I don't really know what this last bit is about, to be honest. Don't really know what the fundamentals mean. So, is that like, you know, when we went through the technical analysis and fundamental analysis? So that was about fundamental. A method of evaluating markets that use multiple data sources to find assets fair value to see if it's overpriced and underpriced. A way of looking at the Forex market by analysing economic, social and political forces that may affect the current prices. So that's for a reversal, do change, which is usually the catalyst for the change, whereas fundamentals do not change. Fundamentals do not change for a retracement. Identifying retracements. Method 1, Fibonacci retracement. A popular way to identify a retracement is to use Fibonacci levels. To identify Fibonacci levels can be used to identify retracements. For the most part, price retracements hang around the 38.2%, 50% and 61.8% Fibonacci retracement levels before continuing the overall trend. Price retracements hang around the 38.2%, 50% and 61.8% Fibonacci retracement levels before continuing the overall trend. If the price goes beyond these levels, it may signal that reversal is happening. Notice how we didn't say will. So it will. I'm starting to like see that whenever like any trading website gives say like a help tip, I guess, it's not always going to happen. It's always going to be like a might or will. So yeah, I guess in the future, don't always think that because it's a sign for something, then that something is always going to happen, because it might not. Who knows? If the price goes beyond these levels, it may signal that a reversal is happening. As you may have figured out by now, technical analysis isn't an exact science, which means nothing certain, especially in Forex markets. Price chilled at Fibonacci retracement levels before continuing the overall trend. So these are the retracement levels. So it hangs around here, and then went up again, and then it hangs around here, and then went up again. In this case, so here's like the 50%, 38.2%, 61.8%. In this case, the price took a breather and rested at the 61.8% Fibonacci retracement level. So here, before resuming the uptrend. After a while, it pulled back again and settled at 50% retracement level. So here, before heading higher. Number 2, pivot points. Another way to see if the price is staging a reversal is to use pivot points. Pivot points can be used to identify reversals. In an uptrend, traders will look at the lower support points S1, S2, S3 and wait for it to break. In a downtrend, Forex traders will look at the higher resistance points R1, R2, R3 and wait for it to break. So in an uptrend, look at the lower support points, so S1, S2, S3 and wait for it to break. In a downtrend, look at the upper resistance points, R1, R2, R3 and wait for it to break. If broken, a reversal could be in the making. For more information or another refresher, check out our pivot points lesson. We need to highlight this, copy. So Fibonacci price overall, place it between here, like that, and then let's do one for pivot points as well. So in a downtrend, pivot points can be used to identify reversals. So we can see that the overall trend was in an uptrend before. If price was in an uptrend and broke through the support lines, a reversal could be in formation. So we've got the R1, what does that say? Oh, PP pivot points, R1, R2, support 1, support 2, support 3. If price is in an uptrend and broke through the support lines, so if it went through here, a reversal could be in formation. Method 3, trend lines. The last method to use is trend lines. When a major trend line is broken, a reversal may be in effect. Trend lines can be used to identify reversals. When a major trend line is broken, a reversal may be in effect. Okay, so major trend line resistance, so we can see that every time the price hits the trend line it bounces back down again. So here, broken through trend line, possible reversal, but this bit here broke through, so then it goes into an uptrend, whereas the overall trend before was a downtrend. Whilst these methods can identify reversals, they aren't the only way. At the end of the day, nothing can substitute for practice and experience. With enough screen time, you can find a method that suits your Forex trading personality and identifying retracements and reversals. Protect yourself from reversals. Protect yourself from reversals. Whenever Happy Pip goes swimming at the beach or the pool, she always wears her pink rubber ducky floaters. Whenever she trades retracements, she uses stop loss points. Pink rubber ducky floaters are lifesavers. Stop loss points are capital savers. Ooh. As we said before, reversals can happen at any time. Retracements can turn into reversals without warning. Can turn into reversals without warning. Therefore, use stop loss points when trading retracements. This makes using trailing stops in trending markets very important. With trailing stop loss points, not just normal, so therefore use. You can effectively prevent yourself from exiting a position too early during retracement and exit a reversal in a pinch. Conclusion: you don't have to be shot down by the smooth retracement. You don't have to lose all those pips, and you most certainly don't need to wear pink arm floaties. Although if pink's your favorite color, it's okay, we don't judge. Just know how to distinguish retracements from reversals. This is part of growing up as a trader. Having the ability to do so will effectively reduce your losses and prevent winners from turning into losers. With lots of practice and experience, you'll find yourself being able to trade accordingly to retracements and exit with a profit more times than not. May we also suggest further reading on this topic? These forum threads may be able to help you out. How do I know if a trend is losing strength? Best indicator for gauging the strength of any current trends and trend channels and price action. Okay, but first let's do the quiz. Quiz time. Market environment. Market behavior is constantly changing between fast, slow, up, down and sideways. Can you tell the differences? Which among these is a possible market scenario? All of the above. True or false? The less liquid a currency pair, the more volatility we can expect. False. Which of the following pair groups are good for range-bound strategies? Currency crosses. In an uptrend, the price usually forms higher highs and higher lows. What does a relatively tight Bollinger Band indicate? Low volatility, right? Which among the following can be used to identify in identifying retracements? Both. How can you protect yourself against sudden reversals? By placing stops. How do you classify a market scenario in which the price is moving in one direction? Trending. When there is a significant change in fundamentals, which among the following can take place? Reversal. Which indicators are used to determine the strength of a trend? ADX, isn't it? What price behavior is defined as a temporary move against the established trend? Retracement. True or false, the lower the value of ADX, the stronger the trend? False. True or false, reversals can occur at any time? True. If the price bounces between a specific low price and a particular high price, what type of market scenario is seen? Ranging. Damn, 14. This is the first time I got 100%. Cherish those sweet victories and look for low scores that you want to improve. Your best score better than 84% of all quiz takers. What? How can an extra 16% do better? Do they answer it faster? Utter perfection. Very nice. Okay, how to trade breakouts. What are breakouts and how can I take advantage of them? Unlike the breakouts you might have had as a teenager, a breakout in the trading world is a little different. A breakout occurs when the price breaks out of some kind of consolidation or trading range. The price breaks out of some kind of consolidation or trading range. So like a flat horizontal section of the graph. A breakout can also occur when a specific price level is breached, such as support and resistance levels, pivot points, Fibonacci levels, etc. Can also occur when the specific price level, when a specific price level is breached, such as support and resistance levels, pivot points, Fibonacci levels, etc. With breakout trades, the goal is to enter the market right when the price makes the breakout and then continue to ride the trade until volatility dies down. When trading breakouts, the goal is to enter the market right when the price makes a breakout and then continue ride the trade until volatility dies down. Volatility, not volume. You'll notice that unlike trading stocks or futures, there is no way for you to see the volume of trades made in the Forex market. With stocks or future trades, volume is essential for making a good breakout trade, so not having this data available in the Forex leaves us at a disadvantage. Because of this disadvantage, we have to rely not only on good risk management, but also on certain criteria in order to position ourselves for a good potential breakout. If there is a large price movement within a short amount of time, then volatility will be considered high. So, volatility is considered high if there is a large price movement within a short amount of time. Volatility is considered low if there is a small price movement within a short period of time. Considered high, there's a large price movement, low, small price movement within. So both would be short period, right? Okay, in a short period of time. Whilst it's tempting to get in the market when it's moving faster than a speeding bullet, you will often find yourself more stressed and anxious, making bad decisions as your money goes in and then goes right back out. This high volatility is what attracts a lot of forex traders, but it's this same volatility that kills a lot of them as well. The goal here is to use volatility to your advantage. Rather than following the herd and trying to jump in when the market is super volatile, it will be better to look for currency pairs with volatility that is very low. This way you can position yourself and be ready for when a breakout occurs and volatility skyrockets. Right, how to measure volatility. Volatility is something you can use when looking for good breakout trade opportunities. Volatility measures the overall price fluctuations over a certain time, and this information can be used to detect potential breakouts. So, measures the overall price fluctuations over a certain time, and this information can be used to detect potential breakouts. There are a few indicators that can help you gauge a pair's current volatility. Using these indicators can help you tremendously when looking for breakout opportunities. 1. Moving average. Moving averages are probably the most common indicator used by forex traders, and although it's a simple tool, it provides invaluable data. Simply put, moving averages measure the average movement of markets for an X amount of time, where X is whatever you want it to be. Moving averages measures the average movement of the market for an X amount of time, with X being whatever you want it to be. For example, if you applied a 20 simple moving average to the daily chart, it will show you the average movement for the past 20 days. There are other types of moving averages such as exponential and weighted, but for the purpose of this lesson we won't go too much into detail on them. For more information on moving averages, or if you just need to refresh yourself on them, check out our lesson on moving averages. Silky smooth moving averages. You can set moving averages to measure several periods or just a few. Moving averages tell us the average price movement over a period of time. Bollinger Bands. Bollinger Bands are excellent tools for measuring volatility because that is exactly what it's designed to do. So volatility volatility can be measured using the following indicators. Bollinger Bands are basically two lines that are plotted 2 standard deviations above and below a moving average for an X amount of time. Plots 2 lines are 2 lines which plot the 2 standard deviations above and below a moving average for an X amount of time, with X being whatever you want it to be. If we set it at 20, we would have a 20 simple moving average and two other lines. One line would be plotted plus 2 standard deviations above it, and the other line would be plotted minus 2 standard deviations below. When the bands contract, it tells us the volatility is low. When bands contract, so they squeeze, volatility is low. When bands expand, volatility is high. For a more thorough explanation, check out our Bollinger Bands lesson. So I think this is the same graph. No, it is the same graph. Bands widen, high volatility, so that's very good. Oh, there's loads of price movements, but then bands contract here, so there's not much price movement going on. Actually, and then Bollinger Bands. Very good. Average true range. Last on the list is the average true range, also known as ATR. The average true range is an excellent tool for measuring volatility because it tells us the average trading range of the market for X amount of time, where X is whatever you want it to be. So average true range shows the average trading range of the market for X amount of time, with X being whatever you want it to be. X being whatever you want it to be. Basically, average true range takes the currency pair's range, which is the distance between the high and the low in time, in the time frame under study, and then plots that measurement as a moving average. So if you set the average true range to 20 on a daily chart, it would show you the average trading range for the past 20 days. So higher average true range equals more volatility. So the higher this is, the more volatile it is. Lower average true range is less volatility. So it's got a low value here, which means it's becoming less volatile. Okay. When average true range is falling, it is an indication that volatility is decreasing. just actually do this. Good. When average true range is falling, volatility is decreasing. When average true range is rising, volatility is increasing. Just remember that the average true range is a volatility indicator, not a directional indicator. Average true range is a volatility indicator, not a directional indicator. So it won't tell you the direction, but it will tell you how volatile something is. It's best used as a technical indicator to help confirm the market's enthusiasm or lack of for range breakouts. To learn more about the average true range, check out our Forexpedia page on average true range. Not a directional indicator. Okay, types of breakouts. Types of breakouts. Breakout begins with the 8 rows of bricks with every 2 rows a different color. The color ordered from the top or bottom is the color order from the bottom up is yellow, green, red, yellow, green, orange, and red using a single ball. Oh snap! Wrong lesson. We're supposed to be talking about trading breakouts, not playing breakouts. Sorry about that. Where were we? When trading breakouts in Forex, it's important to realize there are 2 main types: continuation breakouts, reversal breakouts. 2 types of breakouts: continuation, reversal. Knowing what type of breakout you are seeing will help you make sense of what is actually happening in the big picture of the market. Breakouts are significant because they indicate a change in the supply and demand of the currency pair you are trading. So breakouts indicate a change in the supply and demand of the currency pair being traded. This change in sentiment can cause extensive moves that provide excellent opportunities for you to grab some pips. Right, continuation breakout. Sometimes when there is an extensive move in one direction, the market will often take a breather. This occurs when buyers and sellers pause to see what they should do next. As a result, you will see a period of range-bound movement called consolidation. Right, downtrend consolidation, sellers take a breather. If traders decide that the initial trend was the right decision and continue to push the price in the same direction, the result is a continuation breakout. Just think of it as a continuation of the initial trend. You're so smart. Right. Continuation breakout. So when there is an extensive move in one direction, it's an extensive move in one direction, and the market consolidates as the buyers and sellers pause to see what they should do next. Consolidation, so let's take a breather. If traders decide that the initial trend was the right decision and continue to push the price in the same direction, if traders continue to push the price in the same initial direction, this results in a continuation breakout. Just think of it as a continuation of the initial trend. You're so smart. So you've got the downtrend here, consolidates for a bit, and then continues going downwards. Reversal breakouts. Reversal breakouts start off the same way as continuation breakouts in the fact that after a long trend there tends to be a pause on consolidation. So when there is an extensive move in one direction and the market consolidates as the buyers and sellers pause to see what they should do next. So I'm assuming this is the one where it's a reversal, so it's going to go the opposite direction of the initial trends, probably. The only difference is that after this consolidation, Forex traders decide that the trend is exhausted and push the price in the opposite or reverse direction. Traders then push the price in the opposite direction. This results in a reversal breakout. As a result, you have what is called a reversal breakout. You catch on quick. So we've got the downtrend here, consolidates. In the reversal breakouts, traders feel that the initial trend is wrong and begin to push the price in the opposite direction, and then we're going to push it upwards, which is the opposite of the downward we started with. Cool. False breakouts. Now we know by now you are super excited to start trading breakouts, but you also have to be careful. Just like Lionel Messi can fake out defenders, the market can fake you out as well and produce false breakouts. False breakouts occur when the price breaks past a certain level, support, resistance, triangle, trendline, etc., but don't continue to accelerate in that direction. So, false breakouts occur when the price breaks past a certain level but doesn't continue to accelerate in that direction. Instead, what you might have seen was a short spike followed by a price moving back to its trading range. There might be a short spike and then the price moving back to its trading range. So initial upper and lower range here, consolidates, false breakout as it pops up above its upper range, but then it just shoots back down again, bounces up from its supports, and then just carries on with its being in its upper and trading range, I guess. A good way to enter on a breakout is to wait until the price retraces back to the original breakout level, and then wait to see if it bounces back to create a new high or low, depending on which direction you're trading. So overall trend is going downwards. Initial breakout is here. Wait for new high to be made before going long. Wait until the price retraces back to the original breakout level. So price traces back to here, it breaks out, and then price retraces back to here. And then wait to see if it bounces back, and it does bounce back to a new high or low. Right, okay, so to trade breakouts, wait until the price retraces back to the original breakout level, and then wait to see if it bounces back to create a new high or low. Yeah, so the trend line is here. Price breaks throughout here, so this is the initial breakout. It then retraces back to the trend line bit, which is its original breakout level, and then it does bounce back, creating a new high here. So we wait until the price reaches here, which is where its breakout high was, and once it passes the breakout high, we can place like a buy order here, and then wait for it, and then place a stop loss somewhere. I don't know where exactly though. It should tell us later on in the next few lessons, I think, maybe, hopefully. Yeah. So another way to combat fakeouts is by not taking the first breakout you see. To combat fakeouts, don't take the first breakout you see. By waiting to see if the price will continue to move in your intended direction, you give yourself a better chance of making a profitable trade. Wait to see if the price will continue to move in the intended direction. The downside to this is that you may miss out on some trades in which the price moves quickly without any hesitation. However, you may miss out on some trades which the price moves quickly without any hesitation. But still, not making any profit is still a win than, like, for example, taking a fake out and then trading a fake out, and then losing your pips. So yeah, if you're not sure, just play it the safe way and just wait for confirmation that a breakout is actually a breakout and not a fake out. So nothing wrong with that, I guess. Okay, very good. I am going to leave this episode here. In the next video, we are going to carry on with trading breakouts and fakeouts, with how to trade breakouts using trend lines, channels, and triangles. So thank you all for watching, and I will see you. Save. I will see you all in the next video. Goodbye.